Hey everyone, and welcome to this deep dive. Today we're going to be looking at the wild ride that mortgage interest rates have taken us on recently. Our main source for today is going to be a recent report from the Consumer Financial Protection Bureau, the CFPB. And get this, in January 2021, rates hit a record low of 2.65%.
Wow.
By October 2023, they'd shot up to 7.79%.
A huge jump.
Huge jump. And since then, they've settled a bit around 6.2% as of September 2024. But all of those swings have had a major impact on folks buying homes and refinancing. So let's dig into what the CFPB found.
Yeah, it's a real roller coaster. And you've hit the key points there. I think most people know that global events can affect our economy.
Yeah.
But I think the CFPB report does a really good job of laying out how exactly global forces tied into this interest rate surge.
Yeah, it's fascinating how interconnected things are, right? It's not just what's happening here in the U.S., but the whole world's financial picture that comes into play. So what were some of the big global factors at work here?
Well, one of the biggest was the wave of inflation that hit after the pandemic. Prices were going up all over the place, and central banks around the world, including our own Federal Reserve, had to try to slow things down. And one of their main tools for doing that is adjusting interest rates.
Right. The Fed raising rates is like trying to tap the brakes on a speeding economy. But how did those actions specifically impact what we saw happening with mortgages?
So one of the key moves was the Fed pulling back from buying mortgage-backed securities, or MBSs.
MBSs.
Yeah, to unpack that a little bit. MBSs are essentially bundles of mortgages that get sold to investors. When the Fed was buying a lot of them, that pumped money into the housing market and helped keep mortgage rates lower. But when they started to buy fewer MBSs, well, the opposite happened. Less demand pushed rates up.
Interesting. So less demand for those MBSs meant higher rates for folks trying to get a mortgage. Makes sense. But I've also heard this term spread being thrown around a lot when talking about interest rates. What exactly does that mean in this context?
That's a great question. The spread is basically the difference between the 10-year Treasury yield, which is a kind of benchmark interest rate, and the rates on those mortgage securities that we were talking about. Right now, that spread is about 250 basis points, which is higher than it was before the pandemic. What that tells us is that lenders are pricing in more risk when they offer mortgages, which means higher rates for borrowers.
Okay, so we've got global economic forces, the Fed trying to manage inflation, and this widening spread, all playing a part in this interest rate roller coaster. But let's get down to brass tacks here. What does all this actually mean for a family trying to buy a home?
So let's imagine that you were looking at a $400,000 loan. If you'd been lucky enough to snag that record low 2.65% rate back in January 2021, your principal and interest payment would have been about $1,612 per month.
That doesn't sound too bad, all things considered. But then things took a turn.
Exactly. By October 2023, when rates peaked at 7.79%, that same $400,000 loan would cost you a whopping $2,877 a month. That's an increase of over $12,265, almost 80%. I don't know about you, but that would make a serious dent in my budget.
Yeah, that's a tough pill to swallow. It's not just about the numbers either. It's thinking about the real-world impact on families trying to make ends meet. You know, vacations, a new car, maybe even just keeping up with groceries. Suddenly those things are a lot harder. And on top of that, didn't home prices themselves also increase during this time?
You're absolutely right. Home prices were climbing at the same time that interest rates were going up, creating a real affordability crisis. Think about someone putting down a 5% down payment on a median-priced house. Back in 2021, their monthly payment would have been around $13,359. By 2023, that payment had ballooned to $2,891. That's more than double. It's no wonder so many people feel priced out of the market.
So it sounds like early 2021 was this brief window where even though home prices were going up, those incredibly low interest rates made it possible for some buyers to snag a relatively good deal. But what happened to those people who bought or refinanced during that golden era?
They hit the jackpot, really. Someone who locked in a 2.65% rate in January 2021 was paying just $3,359 a month on that median-priced home, which was only about 23% of the median household income back then. That's manageable. But flash forward to today, and they're sitting pretty while others are grappling with much higher rates.
That's what economists call the lock-in effect, right? If you've got a super low interest rate, you're pretty incentivized to stay put. Who wants to move and face a much bigger mortgage payment? But wouldn't that create a shortage of homes for sale?
You've hit the nail on the head. This lock-in effect is a major factor in today's tight housing market. People aren't selling as much, which means fewer homes are available for buyers, and that drives prices up even further.
So we've got this fascinating situation where a big chunk of homeowners are locked in at those low rates, while others are dealing with much higher ones. What happens next? Where do we go from here?
That's what we'll explore next. The CFPB report also dives into what might happen with refinancing as interest rates continue to decrease. For those with higher rates, there could be a chance to save some serious money each month.
That's what I love about these deep dives. We uncover not just the problems, but also potential solutions. Stick with us. There's a lot more to unpack.
You know, the mortgage market, it's a bit like a tale of two cities right now. We've got almost 60% of active mortgages sitting pretty with rates below 4%. Probably feeling pretty relieved as they watch those rates climb. Knowing that they locked in a good deal.
Must feel like they dodged a bullet, right?
Absolutely. But then there's that other group. Over 20% of mortgages where folks are stuck with rates of 5% or higher. And many of those loans are actually quite recent, which, really highlights the difference those rate swings have made. And this is where refinancing becomes a really important strategy to consider.
Yeah, because if rates keep dropping, which they kind of have been lately, refinancing could be a way for those with higher rates to, save a good chunk of change.
Yeah, exactly. And the CFPB report actually crunched some numbers on this. With rates easing down to around 6.5%, they estimate that about 2.5 million borrowers could potentially refinance and shave at least 0.75% off their interest rate.
That might not sound like a lot, but when you're talking about a mortgage, even small changes in the rate can make a big difference. What kind of actual savings are we talking about here?
So let's say you have a $400,000 loan at 7.25%. If you could refinance to 6.5%, you'd be saving about $200 a month. That's real money that could go towards other goals, like building up your savings investing, or just, having a little breathing room in your budget.
Plus, wouldn't all that refinancing activity have ripple effects on the broader economy too?
It absolutely would. When people refinance and lower their monthly payments, they have more money to spend on other things. That extra spending then flows back into the economy, helping businesses and potentially even creating jobs. It's a classic example of how individual financial decisions can have those wider impacts.
Okay, so far refinancing seems like a win-win. But I'm curious, the report also mentioned that even during past periods when interest rates were super low, a lot of people didn't actually refinance. What would prevent people from taking advantage of that opportunity?
That's a great point.
Yeah.
And it kind of highlights that there's more to the refinancing decision than just the interest rate. For some folks, it might be that the process itself is just too daunting. There's paperwork, credit checks, appraisal fees. It can feel like a lot to navigate, especially if you're a first-time homeowner or just not that familiar with, the whole mortgage world.
So even if the potential savings are there, the hassle factor might outweigh the benefit for some people. What other factors might be at play?
Well, one issue the CFPB points out is that there have been racial disparities in refinancing. Research from the Atlanta Fed has shown that Black and Hispanic borrowers have been less likely to refinance than other groups, even when you account for things like credit scores, how much equity they have in their home, and their income level. And that raises some serious concerns about whether everyone has equal access to these opportunities.
Yeah, it suggests there might be systemic barriers preventing some people from benefiting from refinancing, even when it could really help them financially. What is the CFPB doing to address these challenges and make refinancing more equitable?
They're kind of tackling it from several angles. One is that they're closely monitoring refinancing activity and what lenders are doing to see if any red flags pop up, particularly anything that looks like discriminatory lending practices. They're also exploring ways to make the whole refinancing process simpler and easier for people to understand and go through.
What about those closing costs that come with refinancing? Those can add up quickly and eat into any savings you might get from a lower interest rate.
Right, absolutely. Closing costs can be a major hurdle for people considering refinancing. The CFPB is looking into ways those costs might be reduced, perhaps through policy changes or by encouraging more competition among lenders.
It's encouraging to hear that the CFPB is working to make refinancing more accessible and equitable. But what can borrowers themselves do to navigate this complex landscape and make sure they're making the best decisions for their situation?
Information is key. Stay up to date on what's happening with interest rates and take some time to learn about the refinancing process itself. Don't be afraid to shop around and compare offers from different lenders to see who gives you the best deal. And remember, the CFPB is a great resource for consumers. Their website is full of information about refinancing, including tips on avoiding scams and predatory lending practices.
So even though we're in the midst of this interest rate roller coaster, there are still opportunities for folks to save money and improve their financial well-being if they're willing to be proactive and informed. And it sounds like knowledge is power when it comes to mortgages. The more you understand about interest rates refinancing and what the CFPB is doing, the better equipped you'll be to make smart choices.
Yeah, couldn't agree more. And it's not a one-time thing either. The mortgage market is constantly changing.
Mm,
So you know what might be true today could be different tomorrow.
right. It's not set it and forget it. You've really got to keep your finger on the pulse of those interest rates. Do your research and be ready to jump on opportunities like refinancing if those rates keep going down.
Exactly. And don't forget the CFPB is there to help protect consumers and make sure that the financial system is fair. If you run into any problems or you have questions, they're a great resource.
We've covered a lot of ground today. From those global forces driving interest rate swings to how it all affects families trying to afford a home and the potential for refinancing to provide some relief. As we wrap up this deep dive, what stands out to you as the most important takeaway for our listeners?
I think the biggest thing is to be informed and proactive. Don't just assume that things are going to stay the same. Things are constantly changing, and understanding those changes can make a big difference in your financial well-being.
That's great advice. So, for anyone listening, we'd love to hear your thoughts. If you had the chance to refinance your mortgage today, would you, and what factors would you weigh most heavily in making that decision?
Yeah, that's a great question for everyone to consider. Keep in mind the mortgage market is constantly evolving. Staying informed about interest rate trends and CFPB initiatives can help you make the smartest choices for your financial future.
Great advice. And on that note, we'll wrap things up. Until next time, happy navigating that mortgage roller coaster.